Today marked the historic public trading debut of SpaceX, launching the largest initial public offering in capital markets history. Priced at $135, representing a $1.77 trillion valuation, the stock traded at an average price of approximately $162.50 on its first day, with high initial volatility. This debut establishes a significant new market benchmark, drawing massive retail interest and institutional capital. The speed of this listing has been accelerated by unprecedented changes in benchmark rules. Index providers have discarded long-standing guidelines regarding profitability and trading history to fast-track SpaceX into major indexes. Nasdaq's recently updated fast entry policy allows the company to be included in the Nasdaq 100 index in just 15 trading days, instead of the usual waiting period of several months. This fast-track inclusion creates immense pressure on passive asset managers. With approximately $20 to $25 trillion in assets tracking major indexes, like the S&P 500, index tracking funds will be forced to buy billions of dollars of SpaceX shares almost immediately after listing. This mechanical buying pressure leaves passive investors as price takers, forced to buy regardless of post-IPO valuation concerns. The massive scale of the SpaceX listing is already causing ripples across other tech sectors. The $75 billion capital raise required for the offering has acted as a short-term liquidity siphon, drawing funds away from existing megacap growth and artificial intelligence names as portfolios rebalance. This rebalancing explains the temporary underperformance of other tech leaders as investors reallocate capital. Beyond launch services, SpaceX is actively expanding into the AI ecosystem. The company recently signed a $30 billion compute contract with Google, running from late 2026 through June 2029. This massive infrastructure deal redefines SpaceX's market role, transforming it into a primary provider of AI infrastructure capacity and significantly altering its revenue multiples. While space technology dominates capital flows, traditional industrial giant Caterpillar is also undergoing an AI-driven re-rating. Caterpillar is transforming into a secret AI infrastructure play due to data center power demands. This pivot is supported by a massive backlog of $62.7 billion, which is almost completely equal to its total 2025 revenue of $67.5 billion. This backlog growth highlights the looming power and electricity bottleneck facing artificial intelligence development. As data center power requirements project to grow exponentially, the physical limits of the electric grid are becoming the next major constraint. Industrial leaders like Caterpillar, which supply heavy energy and power generators, are becoming primary beneficiaries of AI infrastructure capital expenditure. While industrial equities adjust, broader U.S. macro pressures are intensifying. New economic data shows that consumer inflation has peaked at a 3-year high as of June 2026. This persistent inflation complicates the Federal Reserve's interest rate path, keeping Treasury yields elevated and prompting Treasury bond volatility. In response to these persistent inflation concerns, retail investors are aggressively seeking defensive income strategies. The combination of high living costs and elevated discount rates has driven a massive capital flow into closed-end funds and master limited partnerships that offer high yields to preserve purchasing power. Leading this trend, the Adams Diversified Equity Fund, trading under ticker ADX, has established a steady managed distribution policy targeting an annual yield of at least 8% of its average net asset value. This shift provides shareholders with predictable quarterly payouts, reducing reliance on variable end-of-year bonuses. Offering even greater dividend longevity, the DNP Select Income Fund provides a highly reliable income shield. DNP has maintained its monthly distribution policy without cuts for over 30 years, paying monthly dividends through multiple market cycles and recessions, serving as a premier defensive asset. Providing a counterweight to inflation worries, the U.S. labor market is showing remarkable resilience. The last few months have marked the best 3-month advance in U.S. payrolls in 2 years. This job growth refutes widespread anxiety regarding labor displacement from automation, as technological integration historically shifts workers to higher productivity roles. As we look ahead, the market's focus will remain on the post-IPO price stabilization of SpaceX and the index rebalancing schedules. We will also monitor the path of core inflation around its 3-year high, data center grid connection limits, and labor productivity metrics to see if today's market rotations can sustain their momentum.